All right, everybody, we are going to have a discussion here on dividends. And specific to, we'll talk about KHC since we have a position there, and how dividends affect option pricing. And for those that remember the discussion we had yesterday with NIO, where we saw discrepancy between calls and puts, part of that discussion was that it's not because of a dividend in that instance. It was truly in NIO, and we'll come back to it after we have this discussion, it was because of the hard to borrow situation. Here, we're going to see that disparity due to the dividend. Okay, so let me get a whiteboard going here first. Dividend discussion. Okay, KHC is $33, and they go ex-dividend tomorrow. And they pay a dividend of 40 cents. Okay? So, first off, let's talk about the mechanics, the fundamentals of what does that actually mean? Okay? If a stock goes ex-dividend, and tomorrow you can see here up in the upper right-hand corner, up here, shows that ex-dividend day 3/7, tomorrow 40 cents. Meaning they're going to pay a dividend to shareholders on record of 40 cents. Well, what happens to a stock when a stock pays a dividend? And why does it go down? Okay, why does it go down? Right, exactly. Okay, because they just, they have 40 cents right now of cash on the books per share that they are giving out to their shareholders tomorrow, so the value of the company has decreased. Well, if everybody knows ahead of time that tomorrow the stock is going to be worth 40 cents less per share, okay? That's a known fact, 100% fact. The entire free world has the information that that is going to happen. Okay, no hidden agenda here. So if everybody knows that the stock will be valued 40 cents lower tomorrow, then what would you want to do option-wise if you knew a stock was going down? If you had, with 100% certainty, you knew that a stock was going down, what would you want to do? Okay. You would, like you're all saying, do one of two things. You would either sell a call, because if we know the stock is going down, then theoretically the value of that call should go down also, or you would buy a put, because if we know the stock is going down, then the value of that put should go up. Okay? Let's put this on the board here. If we all know that the stock is going to be worth less tomorrow, wouldn't we all want to sell calls or buy puts? Okay, just what you guys said, right? That would just make sense. I mean, no hidden agenda here. But everybody knows that, right? So it's got to be factored into the option pricing. Otherwise, everybody would try and take advantage of that. And rightly so. So how do we see that the dividend is already factored into option pricing? Well, let's take a look. I'm going to put these up on the whiteboard. The 32.5 call is 65 cents. The 32.5 put is 47 cents. Okay? Now, remember our discussion. We had it yesterday with NIO. We have it all the time. Our synthetic discussion, our synthetics discussion, where calls can be puts and puts can be calls. Okay? Let me put this up here. Okay, what is the equation? What is the equation for a call to equal a put to equal a call? Okay, what is that equation, everybody? Okay. This equation I'm going to put up here, which we do all the time, is really the key to understanding how puts and calls work in relationship to one another. David, perfect. Stock equals long call minus put. Or I should just say call minus put. Okay? Now, using just basic algebra, we can then solve for how does a call equal a put, how does a put equal a call. So let's just isolate a call. So a call would then equal stock plus put, right? All I did was add a put to each side of the equation there. So a call option should equal the stock plus the put. A put option should equal call minus stock. You're probably all wondering, what the heck does this have any relationship to do with dividends? Okay, but this is how we evaluate and value options to make sure that calls and puts are priced appropriately. Now, going back to the 32.5 call and put up here, how much premium, extrinsic value, is there in the 32.5 call? Stock is 33, calls trading for 65 cents. How much premium, how much extrinsic value is in that call option? Joe says 15 cents. Eric, you say 15 cents. I agree. Faustino, how are you coming up with 18 cents? This one's just a pretty simple equation, guys. Stock is 32.65. I'm sorry, stock is 33. Stock is 33. So the intrinsic value to the 32.5 call is 50 cents, right? Difference between the strike and where the stock is trading. Anything over that amount is the premium. Everybody see that? Okay. How much premium is in the put option? In the 32.5 put? Okay, guys, what is the intrinsic value of the 32.5 put? Good. 0. It's out of the money. There is no intrinsic value. So whatever value, whatever price that put is trading for, it's all premium. It's all extrinsic value. So 47 cents a premium. So that tells us right there something's out of whack. There should be the same amount of premium trading in the call as there should be in the put. But as we can obviously see here, there's not. There's 32 cents difference between the two. Which one is trading higher from a premium standpoint, not an overall price standpoint, but from a premium standpoint, which is trading higher? All right, Ken, I'm glad that you corrected yourself there. Yeah, obviously it's the put, right? The put is more expensive. Why is the put more expensive? It's not because of what we saw yesterday in NIO, just because you can't borrow the stock. It's because of the dividend. And it's because we know tomorrow with 100% certainty the stock is going to be valued 40 cents lower than it is today. So, what do you mean by that, Ken? How does that put the delta of the dividend 100? If the dividend is 40 cents, okay, if the dividend is 40 cents, but the difference in the premium between the two is only 30 cents, roughly. I mean, it's 32 cents here, but it's 30 cents. That's not 100 delta. That's roughly a 75 delta. Okay, well, the way that this works, and this is where it gets a little bit more complicated. I want to make sure that everybody's following at least the rationale so far. That this is why the puts are more expensive than the calls are, because we know the stock is going down tomorrow. So I want to make sure everybody has that fundamental understanding before we move on. Does anybody not follow so far? Because if you don't, let me go back. If you do, I'm going to move on. And Bob Pinto, I see you're out there. I hope you're listening, because I know that you've been studying these Greeks really, really closely. And this is just one of those examples, like I told you yesterday, of how things are all going to start working together here. Okay, Michael. The difference between the strike price and the stock price is the intrinsic value. The strike is 32.5, the stock is 33. So that means that call option is worth a minimum the intrinsic value of 50 cents, right? Because think about it, what does a call option give you the right to do? It gives you the right to buy stock at the exercise or the strike price. Well, if I can buy stock at 32.5 and it's trading 33 in the open market, that's my intrinsic value. It's worth 50 cents, right? Does that make sense? Okay, good. Okay. So, we have now proven that the put is more expensive from a premium standpoint. Let's look at the deltas right now. Okay. The delta of the 32.5 call is 56. The delta of the 32.5 put is 44. Okay. Why is the delta of the call not higher and the delta of the put not lower if we're only a couple days away from expiration or a week away from expiration and we're looking at a call that's 55 cents in the money or 50 cents in the money and a put that's 50 cents out of the money? Hi, David. Okay, why is that, everyone? Okay, why is the call delta not greater than 54 and the put delta less than 46? So basically they're equivalent deltas here, almost 50 each, but we're not at the money. The stock's 50 cents away from being at the money. Exactly, Tim. Exactly. That dividend is factored in. That dividend is already factored in. Meaning, these call options and these put options are already reflecting their values with the stock 40 cents lower. So really, instead of 33, they're factoring in what these deltas and what the theoretical values would be with the stock actually 32.60, 40 cents lower due to the dividend that's going to come out tomorrow. Does that make sense? So Todd, hopefully this circles back then and answers your question on how the dividend is already factored in. Okay, so let's say KHC closes right here at the end of the day today. I know it's $32.99. I'm going to call it 33. Okay, if KHC closes at 33 today, okay, if KHC closes at 33 today, tomorrow morning the stock will open unchanged at what price? So if there were no change in the stock price from the close at the end of the day today to the opening tomorrow morning, what price would that stock open? Yeah, exactly. $32.60. Exactly, because the dividend is going to be taken into consideration. Good. So, if the stock actually opens at 33 tomorrow, that means the stock is actually up 40 cents. Even though it closed 33 today, if it opens 33 tomorrow, that actually means the stock is up 40 cents. Okay, what strikes do we have, Todd? What strikes do we have in our spread? Anybody can answer this, not just Todd. What's our KHC spread? Okay, the 37 and a half. 37 and a half gives you the right to buy stock at 37 and a half, right? That call? Is anybody in their right mind going to exercise their 37 and a half call to collect a 40-cent dividend? Bill, let's not even think about that right now. That is really, not germane to this discussion right now. Right? Nobody is going to exercise their 37 and a half call, which gives them the right to buy stock at 37 and a half. $4.50 higher than where the market is right now, just to collect a 40-cent dividend. That would be a massive, massive loser. We would love if the owners of the March 37 and a half call that we are short, if they exercised their call and we got assigned on those calls. That would be a huge, 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 massive mistake and a huge win for us. Right. The short option would be, Todd, if the short option were in the money, or if it were what's called being exercisable for the dividend, which it's not. Then your thinking is correct. But because these are out of the money options, nobody, unless there is a massive, severe mistake made, would exercise their right on those 37 and a half calls. So, long and short of it is, and Todd, this was a great question that you asked. We are at zero risk of having to pay a dividend here. And Ken, that is not possible unless you already had a short Apple stock position. The call must have been exercised. Otherwise, excuse me. Unless you had a short stock position, Ken, you could not have paid the dividend. How can it can't, Steve. I mean, the only way that it could, actually it can't, because we're in a 1-month spread, because there's not another dividend before our April expiration. So there's no way that it could. If we had a longer time spread on that incorporated another dividend, and the next dividend is probably in June. So let's say instead of being long April calls, we were long these July calls. Then our position could benefit because our short options would not be exercised, but perhaps by the next dividend, if the stock went up enough, we could exercise our long call if the stock went up enough. But in this calendar spread, the March-April, there is no benefit whatsoever. And there's also no risk to the dividend whatsoever. Okay? Keep the questions coming, guys. Keep the questions coming. I'm going to wrap this up. I recorded this. I'm going to get it up into the room here. Is what meaningless, Steve? The dividend in terms of our position? Yes, it's irrelevant. It will not affect our position in the least bit. If that's what you're asking. You're welcome. All right, guys, let me get this posted up here, and I'll be right back. Todd, thanks again for the question.